Hi, it's Brian Decker with your Market Minute. I want to cover a couple of topics today. I want to talk to you about a recession indicator, the inverted yield curve. Many are calling it something that's failing to predict a recession this time, even though it's been very good for the last 50 plus years. An inverted yield curve is when short-term rates like the 3-month, 9-month, 1-year, 3-year, 5-year are higher than the 7 and 10-year rates. And we've had that now for the longest period in 20 years. The length of the inverted yield curve indicates the depth of the recession. Now, there were 21 months of inverted yield curve going into 2008, and that was a 50% decline. We are now at over 24 months. But some are saying that it's not working this time. Well, in August of 2019, the inverted yield curve indicated a recession, which happened in COVID. In March of 2022, that foretold the actual recession of 2022, when the S&P was down 19, NASDAQ was down 33, bonds were down 20. That was a tough year for a lot of people's portfolio in retirement. Our clients actually did well and actually made money in their entire portfolio, the typical client that had all that we recommend. Okay, this time we'll see if it's different. Now, the trigger for the activation of a recession is when the Fed actually starts cutting rates. Within 6 months of a cutting of rate, that's when we look for a recession to occur. So the expectation is that by the end of this year, we should see 2 quarter-point rate cuts from the Fed. So we'll see if that holds true. Second thing I want to cover real quickly is why rates are not going down. The Fed is expecting rates to go down, but they're not. It's because, along with weakening economic information, the unemployment number stays low, the jobs numbers are good, the economy is hanging in there, it's getting weaker, the GDP numbers are coming down, but the Fed sets a set rate, but the open market rates are failing. The bonds auctions are failing, and they're having to produce higher floating rates in the bond market, and they're remaining stubbornly high, the 10-year at 4.4%. So the open market rate is not governed by the Fed. They set the open market rate. This is Brian Decker. Hope you have a good week.